about 26 to 5. It's a Friday afternoon, and it's time to welcome to the studio to talk all about our finances from Envision Finance. It's Luke Smith. Good afternoon.
Mate, good afternoon.
And just before we switched on the microphones, you reminded me the tennis players are out.
Oof, I'm so relieved.
Yeah.
Wow.
Yeah, those social media posts were starting to get a bit annoying.
Yeah, I feel for Djokovic and, in there counting his cash. I'm sure he was struggling.
On the positive side, Serena Williams was saying very nice things about Australia.
Yeah, look, I think, one of these instances where it's been a horrible thing for everybody to have to deal with, and you only sort of get brought to your attention the bad side and the people that whinge about stuff, and I think she was a really good advocate for the systems, the processes, and the magnitude with which everybody's had to deal with stuff, and generally the really good job we've done as a country compared to a number of others.
Absolutely, and it's interesting too, when you see sports people on the field, on the court, wherever, all you're seeing is what they're doing when they're focused on their sport. They're serious, they're focused on that one thing. You don't see them as a human being necessarily, but when you see them just chatting in an interview, whenever you see Serena, she's always so gracious and charming. So.
Yeah, look, I think it's, they're very fortunate that they have a platform and the ability to put forward a very positive message and use their profile for the greater good in the majority of instances, and that's a wonderful example.
You've led me down this garden path. I'm going to go there. Nick Kyrgios, how good is he?
Well, just depends if you come back in your next life as a light post or not, So.
No, in recent times, I think people have grown to love and appreciate Nick because he's been telling it like it is.
Look,
the last 12 months.
And look, those that know me, there's no grey area, so I can understand where he's coming from. If we polished, the edges, I think he's a great athlete, does what he does, and hopefully he's around to be a good advocate for the sport and be a good role model for kids.
Absolutely, and he's been doing great things for the kids. He's been doing great things for bushfire relief, and now, of course, he's been doing great things telling Djokovic that he's a tool.
Well, that I love. Yeah.
Absolutely. We're here to talk about money.
Yep.
And I know that people find that an extremely boring topic unless they want to make some more of it, and then all of a sudden their ears pop up, don't they?
I find there's an age where you say to young children, you need to be an adult, you need to grow up, you need to do this, and I think finance is one of those things where at some point you put your big boy, your big girl pants on and realise, retirement's sneaking up a lot faster than I realised, and now I need to take an interest. So
well, we've been talking in recent times about our superannuation, and last week we were talking about how to get more money into super.
Yep.
We're taking a little bit more of a closer look at part of that this week with non-concessional contributions.
Yep.
Now, as much as that sounds like a very dry topic, what exactly are non-concessional contributions? How do they work, and why are they such wonderful things?
Yeah, so last week we talked about the various ways that you can put money into superannuation, and this is one of them. And I thought it'd be worth breaking this down a little bit because it's extremely powerful, and it ties in with what I just said about people putting their big boy pants or big girl pants on and realising, wow, I need to have some sort of plan to fund my retirement the way I want to live. And this is a really good way of making a contribution to superannuation with money that you may have saved in your own name, money that you may have realised from the sale of an asset, money that you may have inherited from a family member, some lotto money, wherever it's come from. A non-concessional contribution is simply the event of putting money into superannuation and not claiming a tax deduction. And there's a lot of, crossed wires because this often gets missed because a lot of people are aware of the $25,000 limit where you do claim a tax deduction, and that takes into account money from your employer, which we touched on last week.
Yeah.
A non-concessional contribution is just the act of putting money into super and not claiming a tax deduction up to the legislated limits.
Okay, well, I was going to say, I can understand why they want to put a limit on the amount you can put in and get a tax concession, a tax deduction.
Yep.
Is there a limit on the amount you can put in and not claim a tax deduction?
Correct, there is. So there are two sides to it. So the general limit is $100,000 per financial year per person. Or let's say you did sell an asset. Let's say you had an investment property, you owned a building, you downsized your house, and you had a larger amount of money floating around. You're able to put in a $300,000 contribution per person in one go, but that then locks you out for the following 3 years. So that's effectively 3 lots of 100.
So you can put in 3 years worth all in one go, but then you have to wait for the catch up before you can put in any more.
You're locked out for that period of time, and then it resets, and you need to keep in mind that there are also limits in relation to the amount you can put in depending on your total superannuation balance. And that's where the 1.6 million transfer balance cap limit comes in, which can catch people a little unawares.
So if I'm hypothetically selling my house and I've got a spare $600,000 left over after everything,
Yep.
and I haven't put any non-concessional contributions in for the past 3 years, can I put in $300,000 now and then another $300,000 in the following financial year and then lock myself out? So can I? No. I just thought I'd try and
No, but we can skin
create
that
a loophole.
Okay,
there.
but we can skin that cat a different way. So you can make a $300,000 non-concessional contribution with cash.
Mhm.
If you're over the age of 65, you could use a $300,000 downsizing legislation and get your $600,000 in.
Okay.
But when it comes to using this, and one of the points I've got in here is, you need to be a bit sharp about how you use this, right? So if it's applied to the financial year, what I'd be saying to people is, let's put 100 in June. We don't put 101 in, because if we put in 101,000, we trigger the 3-year rule.
Yeah.
So we put $100,000 in before the end of the financial year, and on the 1st of July we throw $300,000 in. You can effectively get $400,000 per person
Yeah.
in the space of 2 weeks.
Yep.
And then obviously with that 300 going in, you're then locked out for that period of time
Yep.
where it resets, and then provided you're not at the maximum super limit, you can then look to try and do that again. But you need to always keep in mind with this that the first question you have to ask yourself is, can I make a contribution to super? Okay, and if you're under the age of 65, there's no work test to meet. If you're over the age of 65, you need to do 40 hours in 30 days. Okay, the other caveat we have with the non-concessional contributions is, over the age of 65, you lose that 300,000 bring forward window, and you can only put $100,000 a year in where you're over the age of 65.
Okay.
So if you are approaching 65 and you're thinking about selling an asset and getting it into super, and people then say, well, why would I want to do this? If you can maximise the amount of money you have in super, decide to finish work, or quit a job and meet a condition of release,
Yeah.
you can start an income stream and make everything inside your super fund 100% tax free. Not only coming out to you because you're over the age of 60, but anything earned on the investments in the pension account are also 100% tax free and 100% exempt from capital gains tax. So if you bought CBA back in the day in your super fund for $20,
Yeah.
and you go and sell it at $85 in a pension account, provided you're not over the $1.6 million limit, you pay zero tax on that transaction. So that's why people want to use this sort of legislation to get everything into a tax-free structure once you start a pension, retire from the workforce, and start to fund yourself and live the way that you want to live.
Okay. So the are there other types of non-concessional contributions aside from if you happen to have, you've sold your house or whatever? Are there other circumstances where this might be appropriate for you to pursue?
So other ways to use this would be to balance out your accumulated superannuation. One problem that we have in the ACT, because of the defined benefit nature of the government super schemes, is that some people with many years of service actually reach the $1.6 million limit, and they do that simply by receiving a $100,000 pension from their defined benefit income stream, be it CSS, PSS, MSBS or DFRDB. So if you're in one of those schemes and you take a $100,000 pension, you multiply that pension by 16, you're at 1.6 million. So one strategy there for people to consider is using the non-concessional rules to increase the balance of a spouse's account and looking to pull money out of your account where you can and add it back into a spouse's account, because anything over 1.6 million is not tax-free. So if you can manage that leading into retirement and increase the balance of a spouse's account, provided they're not over that $1.6 million limit, you've then got tax-free income that you can benefit from in retirement.
Now, you've mentioned this $1.6 million limit a few times, and you've just said now that anything over that, it's no longer tax-free.
Correct.
Now, obviously, there's a lot of people that are under that limit, but some people are lucky enough to accumulate 1.6 million or more. So what do they do with that extra money? Is there any other way to manage that situation where they've exceeded that limit? Are there strategies to deal with that?
Yeah, so, and again, great point, because everybody gets their undies in a bunch over 1.6. And I had this conversation with someone just yesterday. Oh, I can't get into 1.6. Once I hit 1.6, it's all over. 1.6 is not the maximum amount of money that you can put into super. 1.6 million per person is just the limit at which everything inside the fund is tax-free. So you could end up with 2 million, 3 million in super through either accumulation of your wealth over your working life or different ways of putting it in. What you can do to try and then limit the 15% tax paid on the earnings from the assets that are greater than 1.6 is to maximise the franking credits in your tax-free pension account, which could help offset the excess account that you will maintain on the 1.6 and up.
Yep.
You can rebalance things with a spouse. There's lots of different ways to try
and just rewinding a moment there, once you hit that $1.6 million limit, it doesn't mean you lose your tax concessional status. It means that the tax concession applies only to the assets under that limit.
Correct, exactly right. So you could have $2 million in super. You've got a tax-free pension made up of $1.6 million, and then you've got $400,000 in excess. And the earnings on that $400,000 would be taxed at 15% as a general rule.
So it's not as terrible as some people might say.
No, and as I said to a gentleman yesterday, don't freak out about this. It's if it's a first world problem and you're only paying 15% tax on a chunk of your assets, it's not the end of the world.
No, it's not. And as a businessman famously said years ago in a totally different context, he said, I don't understand why people complain about paying tax. If you're paying tax, it means you're making a profit.
Well, and look, I don't disagree with that. I know everybody wants more money in retirement and there's never enough, regardless of the figure. But it's something that, again, you need to be mindful of because there are a number of active strategies that you can take advantage of.
The point is that if you're paying a little bit of tax because of this rule, the reason you're paying it is because you're actually better off than most other people.
You're not starving. Exactly right. Exactly right. But again, a very good illustration of the benefit of getting some advice and using these sorts of contribution methodologies to limit the amount of tax that you pay to be able to then incorporate spouses and other ways to invest to make sure that you are getting the greatest bang for your buck. Because ultimately, everybody says to me, well, I've worked my entire life, I've saved up this amount of money, it's my right to be able to live the way I want to live, and I totally agree with all of that. And you'd be mad if you don't look at some strategies to try and mitigate tax where possible.
Now, this is a question that's never going to apply to me, but I'm just curious to ask it. Forget about your $1.6 million limit. What if you're one of the very few people that's got like, I don't know, 50, 60, $80 million, a couple of $100 million? None of this is really anything you worry about, is it? You've got other strategies that you're pursuing.
This is where you need to put things into context, right?
Yes.
So if you've got an asset base that is so far outside of the realm of normal.
Yeah.
One, there's only so many logs you can hide things in.
Yes.
Two, you're then looking to try and take advantage of other structures where you may have family trusts, you may have companies where you're limiting tax at the company rate as opposed to your marginal tax rate.
Yeah.
It's always about looking at the total resource pool that you have and ways that you can continue to grow your asset base and fund your lifestyle in a way that will let you live the way that you want to live and do the things you want to do without paying an unnecessary amount of tax. And the government has done a very good job of making it harder and harder and harder to be able to benefit from individual investment structures, one being superannuation, because ultimately they need to collect as much tax as possible. Because if the government was pro about having people fund themselves in retirement, the deductible contribution limit would probably be around 100, which it was when I joined the industry in 2000. It's always going to be that seesaw of fund the nation, pay for some infrastructure, and not give people too much of a free kick.
Yeah. Now, just one more question on this $1.6 million limit. Once you hit that level, is it still worthwhile putting your extra money into superannuation, or would you then start looking at alternative investments to superannuation?
Okay, so it's really a really good question because once you hit that limit, this type of contribution ceases to be available. Okay, so very important that we keep that in mind. You hit 1.6, you can no longer make non-concessional contributions to superannuation.
Okay.
You can make a deductible contribution, which is the $25,000. So that could be claiming a tax deduction or superannuation from an employer. You can continue to do that if you've hit 1.6, but making this type of contribution that we're talking about today ceases to be available.
So then you would certainly be looking for alternative options.
So then you're looking at, okay, do I invest in a family trust? Do I invest in my spouse's name?
Yeah.
Do I then invest through a company? What can I do to try and have control over my asset base, continue to invest and grow my wealth, but also then control the underlying tax output of what you're invested in?
On 2CC, it's about 11 minutes to 5, and today we're talking about non-concessional contributions with Luke Smith from Envision Financial, and we'll be back with more in just a moment. 7 minutes to 5 on 2CC, and in this half hour I've been joined in the studio by Luke Smith from Envision Financial. Today we've been talking about non-concessional contributions to your superannuation. I know it sounds dull, but it's actually quite exciting, especially if you get somewhere close to that $1.6 million limit in your super fund. So Luke, what are some key strategies that people should consider and remember?
Yeah, so I'd be looking at, we touched on it before the break, on the timing of your contribution. Don't just race out and throw 300 in. Manage how you put that money into the fund. So think about making a $100,000 contribution in this financial year, with $300,000 being put in July, because that 100,000 limit resets on the 30th of June every year, as long as you don't put in more than 100,000. You put in 101,000, you've triggered your 3-year rule. Put in 100,000, 1st of July it resets, you can get $400,000 in the space of a couple of weeks. I'd be looking at maximising or withdrawing and making recontributions for spouses. If you're getting close to 1.6, you can build up a spouse's superannuation benefit, provided they're of a similar age and they're going to access it at a similar time. You then be able to have more of your total retirement capital in a tax-free structure. I'd be looking at getting money in if you're approaching 65, because from 65 onwards you lose the ability to throw in that $300,000 contribution outside of the downsizing legislation, which could be another way of getting that money in as a little side strategy. I'd also be looking at making sure that the structure you're using is generating as much of your income as possible up to the 1.6, so that you could potentially use franking credits to negate the tax on any excess contributions. If you're in a defined benefit scheme, make sure that you're incorporating a spouse, because a large portion of the threshold will be used with your pension entitlement. So making contributions in a spouse's name is going to be really, really good and really advantageous. Consider other structures. So if you get to the limit, think about family trusts, think about holding some assets in your own name, because you're going to have tax-free money coming out of super over the age of 60, which means you could accumulate a significant amount of asset in your own name and still pay minimal tax using your marginal tax rates in your own names. So there's some things that people can consider, but it's always about looking at your broader situation and saying, right, what's my time frame? How am I going to fund my lifestyle? What do I need? And where's the best way to be able to accumulate assets in the right place to mitigate, obviously, paying unnecessary tax?
And if I don't have a house to sell, what's the best way I can get a hold of $300,000 quickly?
Well, that helps. I'm all out of balaclavas.
Yeah.
So it's
tempting, isn't it?
It's just about being mindful and not leaving it. I guess what we've illustrated today is, don't leave it to the last minute, because you could actually make it extremely difficult for yourself, or find out that you may need to work for an extra period of time to be able to make contributions, which may not be part of your broader retirement plan. So, leading into retirement, be proactive, have some time up your sleeve, do things consistently and in a stress-free environment. You don't want to be making these decisions under duress, because finishing work in some situations is quite scary for some people. So,
well, yeah, it certainly is. So as we approach the end of the segment today, Luke, where can listeners get more information?
yeah. So as always, 6260-4749. Give us a ring, come in, have a chat, sit down, throw around some strategies, have a health check, be aware of what your options are. We've got envisionfinancial.com.au. We've got the Knowledge Centre there. You can subscribe to that for free. There's a bank of technical information, this being one of them. There's some videos to watch, there's articles to read. We've got the podcast, The Strategy Stacker, Luke Talks Money, on Spotify and iTunes. And we've got the YouTube channel, Envision Financial Canberra, where we've got all the key takeouts of the show and the video footage, so you don't have to read anything. You can watch it on your phone, pause it, write things down, and have the key messages written out at the end of the show and some bullets. So it's all there for people to collect the information and watch it, read it, see it the way they prefer. So
Fantastic stuff, Luke. Thanks very much.
we'll see you next week.
We'll catch you again next Friday afternoon when Luke Smith from Envision Financial returns to the studio to talk dollars and cents.